Bank of America and Strategic Management. Bank of America Corporation, Banking and Financial Services Corporation, formed through Nations Bank's acquisition of Bank America in 1998. One of the largest banking organizations in the United States, Bank of America is headquartered in Charlotte, North Carolina. The bank's history dates to 1904, when Amadeo Peter Giannini opened the Bank of Italy in San Francisco. It eventually developed into the Bank of America and was for a time owned by Giannini's holding company, Transamerica Corporation. It issued the first bank credit card, Bank AmeriCard, in 1958. Now, Bank of America is the second largest bank in America with over $2.17 trillion in assets and over 5,300 locations. Its strategic plan is centered around organic growth. The company has shifted its perspective operationally from internal to external. Changes have been made throughout the company over the last 10 years, and of course, its portfolio has also been diversified. Bank of America's mission and vision are centered around these operating principles: being customer driven, creating a great place to work, managing risk, operational excellence, and delivering to their stakeholders. They want to help people understand their money and how to build better money habits. They are connecting customers, clients, employees, and communities to the tools, products, and education they need to help make their financial lives better. What is the external environment? Bank of America must work within a climate of extensive federal and state rules designed primarily to protect the public interest. No new bank can enter the industry without government approval. The types of deposits and other financial instruments sold to the public to raise funds must be sanctioned by each institution's principal regulatory agency. The quality of loans and investments and the adequacy of capital are carefully reviewed by government examiners. Economic factors that affect Bank of America's external environment include the financial crises of the early 2000s. Over the short term, the financial crises affected the banking sector by causing banks to lose money on mortgage defaults, interbank lending to freeze, and credit to consumers and businesses to dry up. For the much longer term, the financial crises impacted banking by spawning new regulatory actions internationally. Other factors that affect the company's external environment include technological and legal segments. Technologically, Bank of America has been promoting using online banking and mobile banking as well as ATMs for most of your financial needs. Legally speaking, Bank of America has been open to a number of different lawsuits over the years that include anything from mortgage to race discrimination. Although the industry experienced severe ups and downs over the past 5 years, commercial banks are set to recover in the 5 years to 2020. Banks endured massive loan losses as a result of the financial crisis, causing revenue to contract significantly. However, improving consumer confidence and corporate profit will facilitate improvements in the credit market, enabling operators to grow their deposits and offer competitive rates. Key risks in the industry include risk of entry, bargaining power by suppliers, rivalry among established firms, threats of substitutes, and bargaining power of buyers. The company's strengths include great brand image, superior customer service, and high customer satisfaction. It also has diversified variety of financial services and products along with strong internet banking presence. Bank of America also has a strong global presence. Due to various acquisitions, mergers, and joint ventures, the institution has a strong position and presence in domestic market. Weaknesses include a client base in over 150 countries, but the company only generates 90% of its sales in the national market and just 10% internationally. Weaknesses also include mismanagement of federal bailout and management dilemmas, resulting in the resignation of 6 directors and formation of a regulatory collision office. Opportunities include Merrill Lynch clients, emerging markets, and fewer competitors. Threats include government regulation, volatile credit market, and consumer perception. Business level strategy. Preferred rewards. Bank of America has been trying to improve its ability to cross-sell its products for some time now. The company seems to be going in a different direction, targeting customers by offering VIP perks to more customers than its competitors. Now Bank of America is targeting the mass affluent, which describes the upper end of the mass banking market. Mass affluent customers have either $100,000 to $1 million in liquid assets or have incomes greater than $75,000 per year. In order to target this group, Bank of America is opening its VIP type benefits to a wider range of customers. Formerly targeted more toward the wealthier customers with more than $50,000 in Bank of America accounts, the threshold has been lowered to $20,000, including assets in both deposit and investment accounts. There are 3 tiers of benefits in the new Preferred Rewards program: Gold, which has incomes of $20,000, Platinum with incomes of $50,000, and Platinum Honors with incomes of $100,000 or more. As would be expected, the benefits get sweeter in the higher tiers. Business level strategy is the attempt to leverage a company's core competencies against opportunities and threats to form competitive advantages while remaining within the realm of a corporation's culture. Combined, Bank of America is able to leverage a huge innovation competency to differentiate itself in a very mature and competitive market, effectively raising perceived service values among its clients and even possibly driving down its own cost of service in the process. The driving forces behind Bank of America's distinctive competencies are efficiency, responsiveness to customers, and innovation. Bank of America's distinctive competencies arise from size, depth of service offerings, experience, and access to financial and intellectual resources. These distinctive competencies help Bank of America achieve its competitive advantages: leading market position, unmatched convenience, and the ability to withstand financial crises and economic slumps. Efficiency stems from years of experience in the banking industry and a strong Six Sigma initiative, but is persistently challenged with new business acquisitions. The company benchmarked world-class companies and set a target of 90% for customer satisfaction. Bank of America's credit card assistance and Clarity commitment programs are similarly designed to increase customer responsiveness. Innovation in the highly regulated banking industry is difficult, yet Bank of America continues to create cutting-edge services like online banking with access to non-Bank of America accounts and broad complementary services. On September 14, 2008, Bank of America announced its intention to purchase Merrill Lynch & Co. Incorporated in an all-stock deal worth approximately $50 billion. Merrill Lynch was at the time within days of collapse, and the acquisition effectively saved Merrill from bankruptcy. This acquisition made Bank of America the largest financial services company in the world. Now, Bank of America has operations in more than 40 countries throughout Europe, the Middle East and Africa, Asia Pacific, and the Americas. Corporate level strategy. Bank of America participated in horizontal integration by acquiring the banks Fleet Boston and LaSalle Bank. Advantages of this integration include reduced competition. Disadvantages for this acquisition were subjectivity to antitrust laws. Acquiring the credit card technology company Work Incorporated was vertical integration. Advantages of this acquisition were increased revenues and control. Disadvantages included higher bureaucratic costs. Diversification allows for Bank of America to stay profitable among its many business avenues. The company has diversified its portfolio by adding different lines of business that include home loans, global wealth, deposits, global markets, and global card services. Bank of America's organizational structure is a matrix structure. A matrix structure is an organizational arrangement that relies heavily on cross-functional teams that each work on a different project. Advantages of having a matrix structure include flexibility to move employees between projects, autonomy for employees to experience variety of projects, and it flattens the organizational hierarchy. Disadvantages include creating conflicts of interest between functional departments and lines of business, considerable time to form teams and develop norms and values. It can also be difficult to coordinate projects where employees have multiple bosses. Bank of America is currently experiencing a number of strategic development issues. The company is reshaping its organizational structure throughout the different lines of businesses. This includes shifting the duties of management and hourly employees. The company is also closing all of its drive-through windows by July 6, 2015 in retail banks. There will be changes in hours of business as well. The goal is to migrate customers to ATMs, mobile banking, and online banking for everyday financial needs. The company is also planning to implement new ATMs with Teller Assist. All of these changes have put BOA under severe customer scrutiny. However, if the company sticks to its current strategic plan and focus on customer satisfaction, these problems will eventually give way to a happier customer base that have more convenient ways to bank.